It's Kalindu from Study with Kalindu. Today we are going to discuss somewhat of a basic topic but of very high importance. If you are studying financial management anywhere in the world, you will definitely come across the topic that we are going to discuss today as the first chapter of your course unit. So, in that sense, this topic is a universal topic. Firstly, before we jump into the content, I would like to invite you to subscribe my YouTube channel Study with Kalindu and press the bell icon for instant notifications of new videos. I am available on social media, Facebook, Instagram and TikTok at Study with Kalindu is my handle. I kindly invite you to follow me on those platforms as well. I do accept private tutoring requests. So if you have any such requests, please send me an email at info@studywithkalindu.com. You can learn more about my offerings and the recommendations and feedback from my past students through my website www.studywithkalindu.com. So let's look at this important topic. Though basic, it's very important. We are going to look at today. The topic that we are going to look at today is the three main objectives of financial management. Three main objectives. When it comes to financial management, if you are a finance manager in a company, you have to ensure that you are delivering these three objectives. What are these objectives? The ultimate objective is maximizing your shareholder wealth. Maximizing your shareholder wealth. That is like the overall goal of the finance function. However, to ensure that you are maximizing the shareholder wealth, you need to have three sub-objectives covered or under control. What are these three sub-objectives that will lead to that main objective of shareholder wealth maximization? These three sub-objectives are financing the company's operations in the most optimal manner, investing in the most rightful and highest profit generating or wealth generating projects, and then ensuring that the shareholders are receiving timely, precise dividends. So these are the three sub-objectives. Now, with respect to these three objectives, you have to make, as a finance manager, you have to make three key decisions. And these decisions are, like we discussed, financing decision, investment decision, and dividend decision. Now, some course units might look at these as objectives, some other course units might look at this as decisions. However it's about these three things: financing, investing, and dividends. Now, what do you mean by financing? Well, when you are conducting the company's day-to-day operations, you need to have proper debt and proper equity structure balance that would enable the company to grow. What do I mean by that? So, you have the company's short-term operations that ideally should be financed by short-term debt and short-term equity sources. If I have to give you an example, now as a company, you need to purchase inventory so that you are able to manufacture or provide the service that you are providing to your customers. For this, to purchase inventory, ideally you should use a portion of the revenues that you are receiving from your customers. However, for you to finance your inventories, if you have to go ahead and obtain bank funding, that could be a bit of a tricky scenario to deal with. So, companies have different measures to track whether the company is headed towards the right decision in terms of financing their short-term and long-term operations. One such metrics or measurement is the current ratio. Current ratio looks at the ratio between your current assets and current liabilities. If the current ratio is less than 1, meaning if your current liabilities are greater than your current assets, then that is alarming. The companies look at quick ratio, or what we call acid test ratio, just to ensure that even the company does not consider the inventory's portion of the current assets, still the company is able to finance their short-term requirements or liabilities or obligations without much of a trouble. Now, when it comes to long-term requirements, cash requirements of the company, long-term projects, now those ideally should be financed by long-term resources. So, if you are a listed company, the company might do share issues, or the company might buy or obtain, borrow long-term funding. So, long-term projects ideally should be financed via long-term capital resources or capital sources rather. So, ensuring that the company is properly financed, short-term operations or enterprises via short-term capital funding, and long-term enterprises via long-term funding is a crucial decision the finance manager has to make, and it is one of the main objectives that the finance manager needs to achieve in order to maximize shareholder wealth. Now, if the company is unnecessarily highly geared, meaning the company is having a lot of bank facilities that it needs to pay interest to, the profit before tax will deteriorate. Profit after tax will deteriorate because of the interest component being too high. And as a result, the company will have lesser and lesser amounts for end shareholders, because it's the profit after tax that will be attributable to the shareholders. And then, if the company is too relaxed and lax about collecting their account receivables, then of course the company will not have sufficient wealth or cash at hand to sustain their operations. So it's imperative in ensuring that the company is having a right balance between debt and equity funding, and the company is having sufficient liquidity. The finance manager needs to maintain a good working capital cycle or cash conversion cycle, and of course good liquidity ratios. Now this is about the financing decision, having proper debt and equity balance, having proper liquidity position. What's investment decision? When it comes to the long-term objectives of the company could only grow if it makes proper investments. The improper the company's investment decisions, the lesser the funding or the lesser the worth or wealth the company is going to have into the future. Now, as a company, the company will have the ability to invest in a lot of the projects. There will be a lot of interests in the company at a given point. However, the objective of the finance manager is to ensure that the company invests in the projects that would have the maximum return on investment. So how do you find the return? Well, we have different investment appraisal techniques for that. Starting with the most simple one, payback period. Then you have discounted payback. You have something like internal rate of return or modified internal rate of return. You can have things like profitability index, or you can have discounted cash flows. And the net present value is a technique that's based on discounted cash flows. So generally, net present value is considered to be a well-versed and very versatile solution to calculate or to see how wealthy or how worthwhile an investment is going to be in the future. So company might have different projects at hand. The finance manager will have his or her staff calculating the net present value and making other matrices with respect to different projects that the company is considering, and then finance manager will look at them and say, okay, let's invest in this project because that's going to have the maximum return, and that will in turn maximize shareholder wealth. So I want you to realize that everything the finance manager does is eventually tied up with maximizing shareholder wealth. Now, When you are studying financial management, where there will be narrative questions that you need to answer, you have to ensure that you always tie the answer to that eventual objective of maximizing shareholder wealth. Why is that important? Because it's the shareholders who believed in the company and invested their money behind the company. And it's that money the company has as capital or as share capital that the company is able to use, or the company is able to finance its operations, because the banks all of a sudden will not come and provide bank funding. The company has to have a capital, use that capital, run its show, generate profits, sustain that for some time, and then they can go to a bank and say, hey, we have sustained, we have grown the company, now we need to further grow it. So give us some funds, so give us a helping hand. So that's how it happens. So it's the shareholders that initially believed in the company's operation. So as a result, shareholder wealth maximization has to be the ultimate objective. Now the third and final decision is about dividends. Now shareholders needs to be properly compensated or enticed in order for them to retain with the company. At any given time, a shareholder could sell their shares and walk away. Now, if the company is performing well, there will be a lot of goodwill that is being generated around the company. Many and many shareholders or investors will want to invest in the company. That will create a demand versus supply mismatch. There will be excessive demand for the constant supply of shares. As a result, it's a very simple demand supply relationship. The company's share price will surge. Now, when the company's share price is surging, meaning the company is sending positive signal to the market that, hey, our company is doing great. No shareholder will want to sell the shares and walk away just like that. But I mean, if they have bought at a lesser price, and if today's share price of the company because of the good operations is higher, it would make sense for a shareholder to sell the shares and gain a profit out of it, a capital gain out of it. So there's nothing saying or nothing guaranteeing that the shareholders are going to retain with the company. What therefore the finance manager will have to ensure that shareholders are properly compensated. Yes, if they sell shares, they can gain a capital out of it, provided the current share price is higher than the price at which they bought the shares. But on an ongoing basis, to entice the enterprise or the bond between the company and the shareholder, the company will, or the company could rather, declare dividends. So these dividends will be sweetness, and the shareholders will like to receive them. However, it's the retained earnings portion of the company's capital that the finance manager is going to use in order to pay dividends. Therefore, it's imperative that the company is having an optimal dividend payout ratio. Dividend payout ratio is simple. It's the amount of dividends divided by the profit or earnings, or dividends per share divided by earnings per share. That's the payout ratio. So finance manager needs to ensure that there is an appropriate dividend payout ratio that's not too low, not too high, because if it's too high, it's going to eat into the capital or retained earnings portion that the company will have to invest in the future operations and capital investments. So there has to be a fine balance. So if you look at, most of the companies will pay 3.5 to 5% of their earnings as dividends. So a per share dividend will be very low, but I mean collectively, if a shareholder owns thousands of shares, then there will be substantial amounts of dividends that are going to be deposited. So having appropriate amount of dividend paying out to shareholders at a frequent time periods is going to be a reason for shareholders to stick with the company in the long run. So three decisions: investment, or the financing, investment and dividend. These three key decisions are tied up to three objectives, that is having appropriate debt and equity balance, and financing or investing rather in the most optimal capital projects and paying out appropriate amounts of dividends. And these objectives collectively will enhance shareholder wealth. Having right debt and equity balance for the company's short-term and long-term operations will ensure a high profit to the company, which will maximize shareholder wealth. Investing in the right projects will provide the highest return on investment, highest net profit value. That will once again increase shareholder wealth. And obviously, paying out frequent dividend payments will maximize shareholder wealth. So, if a finance manager is in fact right or correct or accurate and precise with these three key decisions and sub-objectives, the ultimate objective of finance management, which is maximizing shareholder wealth, will be met without an issue. So, wherever in the world you are, whatever the course unit you are doing, if it's about finance management, you will come across this topic as the first topic, the objective of financial management. And I hope this little discussion we had today helped you to have a better understanding about the different financial objectives and decisions the finance manager will have to have in order for him or her to maximize the shareholder wealth, which is the ultimate objective of any listed company. I am Kalindu Somatilaka, a private tutor based in Toronto, Canada. I have been a private tutor for the last 11 years and had the privilege of helping out more than 600 students, more than 20 countries in the world. So, if you are a student studying finance, accounting, economics, econometrics, or statistics or mathematics, do not hesitate to write to me and subscribe to my YouTube channel and follow me on Facebook, Instagram, and TikTok. At Study with Kalindu is my handle. If you have private tutoring requests, do write to me at info@studywithkalindu.com. Visit my website www.studywithkalindu.com and find out more about myself and my offerings. So on another day, let's look at another video covering a basic aspect like this in a different subject. Till then, study well and have a good time. Thank you.